Your investment just dropped. Red numbers everywhere. Your gut says panic. But that loss sitting on your screen could quietly hand you cash back from the IRS, and most people never claim a cent of it. This is the move the wealthy and their accountants run every single December, and almost nobody teaches it to beginners. It has a name. It's called tax loss harvesting, and in the next few minutes you'll actually understand it. Start with a reframe that changes everything. A market dip isn't just pain. In a regular brokerage account, a paper loss can be turned into a real, usable tax deduction. You make the dip work for you. Think about it. You were going to ride out that downturn anyway, so why not pick up a tax benefit on the way through? The loss is happening regardless. Harvesting just lets you actually collect on it. Break the mechanics into clear steps. Step 1. You sell an investment that's worth less than you paid for it. That locks in what the IRS calls a realized capital loss. On paper becomes official. Step 2. That loss first goes to work canceling out your capital gains. Sold something else this year for a profit? Your harvested loss erases the tax on that profit dollar for dollar before anything else happens. Step 3 is the part people miss. If your losses are bigger than your gains, you can use up to $3,000 of that extra loss to lower your ordinary income, like your salary, each year. One quick note. That $3,000 limit drops to $1,500 if you're married but filing separately. For almost everyone else, $3,000 against your income is the number to remember each year. Step 4 is the beautiful part. Still have losses left over after all that? They don't vanish. They carry forward to future years indefinitely, waiting to cancel future gains or income. Nothing is wasted. Make this real with simple numbers. Say you made $5,000 in gains this year on one stock, but another holding is down $8,000. You decide to harvest that $8,000 loss. First, the loss wipes out all $5,000 of your gains. Tax on those gains? Gone. That leaves $3,000 of loss still on the table, sitting there waiting to do even more work for you. Then that remaining $3,000 comes straight off your ordinary income. So you canceled a profit and shaved your salary tax in the same move. One down market just bought you a real, measurable tax break. Now the trap that ruins it for beginners. The IRS has a rule to stop you from gaming this. It's called the wash sale rule, and breaking it quietly cancels your entire tax benefit. The rule is this. If you buy the same, or a substantially identical, security within 30 days before or after your sale, the IRS disallows the loss for now. That's a 61-day danger window around the sale. So if you sell a fund at a loss on Monday and rebuy that exact same fund a week later, the IRS says, nope, your loss is disallowed for now. It gets added to the cost basis of the new shares instead. So you want to harvest the loss without breaking the rule and getting locked out of the market. Because the whole point is you still want to stay invested. The fix is simpler than you think. The answer is to buy something similar but not identical. Sell one broad market index fund at a loss, then immediately buy a different broad market fund from another provider that tracks a comparable but not identical index. This way you stay invested in basically the same slice of the market, so you don't miss the recovery, but the IRS sees a different security. The loss counts, and you never sat on the sidelines. Now a critical detail. This only works in a regular taxable brokerage account. Your IRA and your 401k are already tax sheltered, so there are no taxable gains or losses to harvest in there. And understand what harvesting really does. Selling low resets your cost basis lower, which can mean a bigger taxable gain later, so this often defers the tax rather than erasing it forever. Still valuable, but know the difference. Now walk through doing it yourself. Step 1. Open your taxable account and look for positions trading below what you paid. Those red holdings are your harvest candidates. Make a quick list of them. Step 2. Before you sell, pick your replacement. Line up a similar but not substantially identical fund to buy so you stay invested without tripping the wash sale rule. Decide the swap before you ever click sell. Step 3. Sell the loser and buy the replacement, keeping clear of that 61-day window with the identical security. Step 4. Save the records. Every confirmation matters when tax time arrives next spring. And Step 5. Do not let your other accounts secretly trip the rule. Buying that same security in your IRA or through automatic dividend reinvestment can also trigger a wash sale. Turn off auto reinvest on the loser first. One honest warning. Tax rules shift and your situation is unique. The numbers and limits here are general guidance, not personalized tax advice. Confirm the current rules and your specifics with a tax professional before you act. Here's why this matters. Rich investors don't have a secret stock. They simply refuse to leave free money on the table. Tax loss harvesting is one of those quiet edges, fully legal, totally available to you. You don't need a fortune to use it. You need a taxable account, a down position, and the willingness to act instead of just staring at red numbers feeling sick. The tool is sitting there. Pick it up. Lock it in. Tax loss harvesting means selling a losing investment to realize a loss. That loss first cancels your capital gains, then up to $3,000 a year against your ordinary income. Anything left over carries forward to future years. Dodge the wash sale rule by waiting out the 61-day window or buying a similar but not identical fund. And remember, this lives only in taxable accounts. It won't make you rich overnight, but every year it can quietly trim your tax bill and put real dollars back in your pocket simply by being smart about losses you were going to take anyway. So, here's your challenge. Before this year ends, log into your taxable account and check for any positions sitting at a loss. Just look. You might be holding a tax break and not even know it. Quick question for the comments. Had you ever harvested a loss, or did you not even know this was allowed? And what's holding you back? The wash sale rule, or just not knowing where to start? Tell me below. If this finally made tax loss harvesting click, tap like so, more people can find it. Subscribe for a fresh money lesson every week and send it to a friend who's staring at a red portfolio right now.